On Thursday, U.S. natural gas futures broke through the $1.80 resistance level, recovering from a three-week low following the EIA's storage draw report. The government data printed a draw of -9 billion cubic feet, slightly larger than market expectations, but again decently smaller than the 5-year average of -87 billion cubic feet to increase surpluses from +551 to +629 billion cubic feet. This could be interpreted as a strongly bearish signal for natural gas. However, as I mentioned in Tuesday's forecast, if Thursday's storage report shows a larger withdrawal than expected, it might attract counter-trend buyers. This scenario could trigger an earlier upward movement, especially with the impending cold weather supporting the market sentiment. Consequently, the sentiment is likely to shift as March progresses, with forecasts indicating colder than normal conditions, resulting in larger withdrawals in late March and early April, compared to the volumes seen in the 5-year average. Meanwhile, U.S. gas companies continue to slow down production, as CNX Resources also announced a reduction in well completions and gas production for the year due to lower prices. In the past month, U.S. gas output has declined by 6%, with companies like ECT and Chesapeake Energy deliberately cutting production. Nevertheless, an extended outage at Freeport Train 3, which is restricting gas flow to LNG export facilities, is still adding some downward pressure on natural gas prices. The timeline for the Freeport LNG outage remains uncertain, postponing a return to normal U.S. LNG feed gas levels until the plant fully resumes operations, expected sometime in late March. The technical landscape centers around a pivot point at $1.78, acting as a crucial determinant for future price movements. Resistance levels are set at $1.85 and $1.90, indicating the potential for upward momentum. On the flip side, support levels are established at $1.75, followed by $1.69, which could act as a cushion against further price declines. Meanwhile, as I mentioned in the last video, aggressive counter-trend buyers could come in to test these levels due to the limited risk. A break above $1.78 could signal a shift to a bullish outlook, underscoring the significance of this level in determining the trajectory of nat gas prices. Given the expected decrease in gas production alongside a forecasted increase in demand, the U.S. nat gas market is poised to encounter a tightening supply-demand balance. Such a situation typically indicates a bullish short-term outlook for natural gas prices. Moreover, the latest EIA forecast suggests a gradual price increase to over $3.50 by the end of the year. Of course, there is no guarantee that this scenario will materialize, but there is no doubt that the longer prices stay below $2, the more significant the price burst we will see later. This analogy reminds me of a coil spring. The more you compress it, the stronger the reaction you will experience. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.